Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Oana.
Okay, so we have the July market update for Las Vegas.
Yes.
For the real estate market in Las Vegas. Crazy shocked us. When I first saw the data, I thought I'd done something wrong. When I went to this tool Altos Research gives us, market was smoking hot. Like literally the last week of June, which is the week we're talking about, going into July, was literally the hottest week of the whole spring, which is super unusual.
Right. So the question is, are we going out with a bang?
Okay, let's go through the number. Let's go through all this and we'll talk about it and everything. Okay, so here's the first one. This is this market action index. 46, it actually is higher than it was last week. Remember, it was 45 last week. It's 46. That's a strong seller's market. But when I show you this next chart, this is like the weekly change. For the week, it behaved if it was a 62, 61.97, the 7-day average of the market action index. Remember, it's including everything. It's including like the list prices of homes, what homes sold for, how quickly things sold, you know, homes disappearing from the market. It said that's a super strong seller's market. Now, we did have 2 weeks in a row of interest rates drop. Remember, everyone freaked out 2 weeks about, oh my God, interest rates are getting close to 7, and then 2 weeks in a row, they dropped.
Right. So we do understand that we have economic news coming out today and tomorrow, and that may change some people's minds, but this is looking back. So in order for that economic news to impact housing, that's going to take some time, right?
Yeah.
Okay.
Okay. Now, here's the first thing I'm going to put up, these real-time market profiles. Now, this is week by week. This is how the market changes. It goes back to right now it's going back to March 17th. If we went all the way back to like January when the market bottomed, this was 470. And the median list price is now 569,900. It was 560 a week ago.
Right.
It's already jumped up. It jumped up almost $10,000, the median list price.
But remember, this also has to do with the mix of properties coming on the market. So it's not like your property went up, $10,000. We're not suggesting that.
It's possible that the homes that came on the market were just more higher expensive homes. Just like when the market dropped from the spring to the fall last year, more people sold lower priced homes, and the people with more expensive homes said, I'm not going to put my house on the market. So people are like, oh, look, homes are selling for less. So that's why we use these indexes and measures.
Right. We want to make sure that we're consistent so that you can see a pattern rather than being focused right on the dollar values.
Okay. So as you go down this, the other thing you notice is that price per square foot jumped up to $259. That's the highest we've seen in a year. And I've got some other data to show you that shows we basically are right back to where we were a year ago when you were told, oh, it's going to fall 40, 50%. And then the other thing, too, here is way down at the bottom, okay, where it says inventory. So it's $22.97. This is just for Las Vegas. This is how many properties are available. Now, remember, we have over 400,000 homes, okay? So there was about 2,200 available to purchase. A week ago, on the 23rd of June, a week before this was taken, there were over 2,500. Now it's down to 22,900. So over like 212 properties purchased more than what came on the market.
Right. So not only did we sell lots of properties, but they weren't replaced at the pace that we were selling them at. So that's why we have less inventory now than we did a week ago.
Yeah. And then the strong sellers market, the text below it says, in the last few weeks, the market's achieved a relative stasis point in terms of sales to inventory. However, inventory is sufficiently little to keep us in the seller's market zone. So watch changes in the market action index. If the market set price is likely to resume an upward climb, it kind of looks like it's doing that, but it's like it's not supposed to do that right now. It's supposed to chill out and then decline into the fall. It's not doing that.
Right.
Okay, here's the next one, price per square foot. This is adjusted out per square foot. You can see that we had the decline from last year, but it's climbing again. And then we've had a number of people comments go, no, prices are falling. No, they're not falling. When they're more than they were 2 or 3 months ago, that's called rising. You cannot go back to some point in time and say this is the home price, and until they get to their falling, doesn't really work that way, right?
Right. So, look, we have such limited inventory that, to some extent, this data set, to me, doesn't have as much value as maybe if we had more inventory to really look at. Because we have so few homes on the market, because there are so few transactions, any movement has an outsized impact on these numbers. So you do have to kind of keep that in mind. Yes, the market is improving, and yes, home prices are going up, but a lot of that is simply supply and demand. It's not necessarily that homes are truly appreciating because they're more valuable. They're valuable because there isn't anything out there. There's very limited product, and that's what gives them this value. It's not that the homes have an intrinsic value, but they have value because there's scarcity.
Literally, the first thing we learned in grad school economics is scarcity. It's the most, it literally drives everything in economics. And then something else that's interesting about this chart, this price per square foot chart. If you go all the way back to June of 2018, interest rates were about 4% back then, maybe high threes. And then if you go all the way up back to August 21, remember, interest rates were still really low. Interest rates were down in the 2 and 3% range. But now interest rates are up in the 6s, but look at the difference between prices of homes today. And this is a head scratcher for people, because remember, you were told if interest rates go up, the home price has to drop, because they're like opposite of each other. But this shows the opposite. It doesn't show that's happening because of what Oana said.
Right.
Supply and demand is what drives price. Price is strictly a function of the supply curve and the demand curve and where they intersect. That's all price is. These other factors are not extremely relevant.
Correct.
Because of scarcity. Okay, inventory. This is another one. Last year at this time, look at what inventory was doing. It was skyrocketing. This was the sort of scary thing. We were like, oh my gosh, how high is it going to go? And you see it only went back to like a normal market. It didn't. It was like, oh my gosh, it's going from record lows. And then it went, oh, okay, it just got back to normal market. But look at now, it's just declining. It's still declining. And if you look back over the last 5 years, you can see the inventory, except for 2020, which was when this whole mess started, inventory was increasing, and it's not. It's still going down. Right. I don't think you would have expected this if you'd have said a year from now, okay, interest rates are going to be almost 7%. What do you think prices are going to do in inventory? People would have said 15,000 homes on the market, prices will be 30% less. Right? That's what people would have said.
Right. But that's not happening. And of course, we are probably looking at more interest rate increases from the Fed this year. And that's just going to keep choking off that inventory, because you're still going to have sellers who are going to be even more weary of putting their homes on the market and trying to find another home. So we're going to keep going down this path for a while, which also means that, this pattern probably is not going to resemble past years. We're probably not going to see rising inventory the way we expected in the fall. We thought that we would get that because we thought we might get some interest rate relief. I don't know that we're going to get that. And with that interest rate relief, I don't foresee inventory climbing and having more choices for buyers.
So the other thing we decided to do was we just said, hey, let's see what's going over in condo land. Okay, condo land is very similar to residential, single family, and townhomes. And all the data we've shown you was single family homes and townhouses. Those are included in single family where it's houses, okay? So the market action index was 50, which was higher than it was. And we're like, wow, that's really good. And then we went over to look at the chart where it shows the market action index weekly. If you go all the way to the right, 65.78. It was almost 66, rivaling 2021 market action, where it was a super hot market. It looks like that it's not cooling off. Condo market's definitely not cooling off. The 90-day average is 50. That's like really hot. It's a seller's market for condos. Like people aren't selling their condos and people are just buying and prices are going up.
Right.
Over here on the real-time market profile, as you can see, price per square foot was kind of just chilling out in the last couple weeks, jumped up. And then inventory. So June 23rd, there were 760 condos available. I'm telling you right now, this is a massively low number. Like this is a really low number historically for all the condo. We have a lot of, I mean, 760 condos is nothing. And it went down to 694. So it wasn't just, remember, those were just houses we showed you before. Now we've got all these condos that disappeared, almost 100 condos, but probably, 8-9% of what was available didn't get replaced. And then you can see rents kind of climbing, $1,600 median rent on a condo. That's pretty crazy.
Right.
Okay, median list price here. Now remember, we talked about this before. Condos are in a much tighter range. You don't have, it's not like houses where you have, like the cheapest house we ever bought, we paid like $30,000 or $40,000 for, right? And then you can buy houses for millions of dollars. Condos, except for high-rise condos, condos for the most part are this, property type that they're kind of all about, like in this narrow band of prices, right?
Right.
Because they're meant to be affordable. They're not meant to be big. They're basically like apartments. They're just, 1, 2, 3 bedrooms. They're in, complexes that are in, they're not in super high-end areas. Yes, they do build, like Toll Brothers builds technically their condos. They're super nice. They're really expensive.
Right.
Right? Okay, but when you look at the list price here, it's basically about back where it was at the peak last year, which we said was a bit artificial. It was a imbalance because a lot of people were rushing in to the market because interest rates are starting to go up, right?
Right. So it's interesting, like I said, with the single-family homes and the townhomes, all of this to some extent is artificial because of the lack of inventory. If we get more inventory, then you're going to see more. You're more likely to see prices that stabilize more or that even possibly decline if you have sufficient inventory. But we're not going to see sufficient inventory for a while. With the Fed promising to raise interest rates, that's not going to happen for a while, so sellers are going to stay put. You're still going to have strong cash buyers in the market. You're still going to have people who are putting lots of money down in the market. It's not scaring away people as far as the interest rates are concerned because, remember, Americans tend to get fixed rate mortgages, right? We tend to not get variable rate mortgages. We haven't done that in a long time.
Yep.
We got bitten with that before, and we're not likely to do it again. And especially now that people are seeing interest rates doing this, they're certainly not going to have any appetite for variable rate interest loans. So because of that, people who are in their homes, in their townhomes, in their single-family homes, in their condos, their payments have remained stable and will continue to remain stable throughout whatever happens economically because they have fixed-rate loans. It's only the people coming new to market that have to deal with the higher interest rates, which is why the people who are in their homes currently with those 2, 3, 4% interest loans, they don't have any appetite for 6 and change or 7% loans.
Okay, here's a comparison to 2008. People use the number 2008, but actually started 2006. That's when we started to see the writing on the wall. From 2003 to 2006, basically, for 3 to 4 year period there, home prices were going up pretty substantially. So everyone was getting these 1 and 3 year ARMs that were low for a year, and then the conventional wisdom was, I'll just get this rate. It's lower. It gets me in the house, and then in a year when I have a bunch of equity, because the home will be up 20%, I'll just refi it.
Right.
And I'll get a better rate, and I'll be able to lock a fixed rate mortgage.
Well, the other thing that people were doing back then, they were doing this thing called negative amortization.
Right.
Where you would get the loan, and your payment was not enough to satisfy the interest on the loan, and nothing went against principal. So that your loan balance went up every month rather than going down.
Making the payment.
Making the payment, right. So the idea was, like Todd said, that the homes were appreciating so quickly that you were going to be okay because even though your balance was growing every month, your balance was growing less than the rate of appreciation.
almost, first of all, ARMs still only make up about 6% of all loans.
Okay, so when we're talking about that, we're talking about U.S. loans. We are aware that Canada has a lot of variable rate interest mortgages. We're aware that the U.K. does, but we're just talking about the U.S.
But the very few loans that are ARMs right now, there's two products out there. There's a 5-year ARM and a 7-year ARM. So the people are saying, yeah, but those people with adjustable rate mortgages, they've got 5 more years. They're locked in, meaning if they got a 5-year ARM at 2.5%, they're going to pay 2.5% for 5 more years. So this thing is, oh, interest rates are going to go up and crush them. No, it's not. They don't care. Interest rates could go to 1 billion%. If they go back to 2 or 3% in 5 or 7 years when their ARM adjusts, they're fine because it's going to go back to a low rate. Or they can just sell it, or they can refi. At some point when the rate drops, that's what's going to happen. There'll be a huge refi boom, all the people. There is no comparison between what's happening right now and the 2006, 7, 8, 9. There's zero comparison, especially when you look at foreclosures. It's the opposite. Back then, it was just foreclosure city, and today there are no foreclosures. Here's the last chart, inventory. This is also surprising because look at what happened. If you look at the last 5 years, inventory was stably either staying the same or climbing. It was climbing substantially this time last year, and then now it's declining. There's more decline in inventory right now than any year, including 2021. And look at 2021. I mean, we're actually almost the inventory level we had 2021.
Right.
So here, I'm not saying this is going to go forever and prices are going to keep going up. We've never said that, right? I still think, gut feeling, prices probably be a little softer. There'll probably be some more inventory. Probably get a good deal in the fall. If you have to buy now, then you buy now. If that's what your situation dictates. Not saying not to buy, not saying not to sell. Just pointing out that there's some weird stuff happening right now that is counterintuitive to what we saw for the last 10 years, which was a very stable, appreciating market. If you bought a house, there was a 100% chance it was worth more a year later.
Right.
And there wasn't a lot of, interest rates were substantially different, and there wasn't a lot of weird variability and stuff like that.
Right. So, kind of in conclusion, we've got very low inventory, and that's what's driving prices up. Interest rates are not coming down anytime in the immediate future. That's pretty clear. So with that in mind, we're not foreseeing inventory climbing for a while. And so long as inventory stays low, then prices are probably going to remain stable or increase. Once interest rates start going down, we'll see kind of what happens and what appetite everybody has for that, because it'll be really interesting to see. If interest rates drop, will more sellers come on the market? And will those sellers also be buyers? So will there be more activity but not softening in price? Or will there be softening in price because there are more properties on the market? That's something that we're all going to watch together. Tell us where you're watching from and what's happening in your market. We want to know about that. Please leave us comments. Be nice to each other in the comments. Please subscribe, hit the notification bell, like the video, share the video, and we'll see you on the next video. Bye.
Bye.